Right, good afternoon, everybody. We seem to have quite a few people joined now, so welcome to this webinar, and I think we'll kick off. Today, we're going to be discussing the LMA sustainability-linked loan provisions, some key negotiating points and areas of focus, and the current state of the sustainable finance market. My name is Ellis Lawson. I am a London-based partner in Sullivan's International and Cross-Border Finance team. I joined Sullivan only around 2 months ago from Alan Novery, where I've been for 12 years in their London, Dubai and Abu Dhabi offices. And I've joined as part of our strategy to broaden out our finance practice beyond its trade finance core. And my background is mainly in the corporate lending, acquisition finance and project finance space. So the subject matter of this webinar is broader in its relevance than just to trade finance. I'm joined today by Maria Capocci, who's an associate in our team, who you'll be hearing from in just a minute. And as we go through, if you have any questions, please submit them using Zoom's Q&A function, and we'll try to allow time at the end to address many of those as possible. And equally, feel free to reach out to us afterwards. So now I will hand over to Maria to introduce herself and get us started.
Thanks, Ellis. Hi, everyone. Can I have the next slide, please? So as Ellis has previously mentioned, my name's Maria, and I'm one of the associates at Sullivan's in London. So during today's session, we're going to consider ESG, and more specifically, we're going to focus and share some meaningful insights into various aspects of sustainability-linked loans. And this is hopefully going to provide some broader context on how to approach this type of financing in the market. So during the first section of the session, we're going to give you a high-level overview of exactly what ESG means, and that's going to include identifying some examples of different types of loans that fall under the ESG umbrella. We will also consider the current market position, introduce some of the key elements that are also present in the LMA drafting. The middle section, which Ellis is going to take, is going to offer a more practical discussion, and that's going to address how different parties that are looking to use sustainability-linked loans can negotiate, navigate, and throughout all the key elements of sustainability-linked loans. The key aspects will include key performance indicators, sustainable performance targets, margin impact, reporting and disclosure, and declassification of sustainability-linked loans. And finally, we'll conclude the session by considering how the finance market is developing and what its continued evolution looks like with respect to sustainable financing. And as Ellis mentioned, you can also pop any questions in the Q&A function as we're going through this. Next slide, please. So, as many of you are aware, sustainability has been a hot topic for quite some time, and is very much expected to remain at the forefront of the boardroom agenda for the foreseeable future. Now, we've seen over the last several years, there's been a growing trend in where ESG factors have become increasingly common features in the loan market, and that's across a full range of loan products. There's a lot of discussion as to what ESG actually means, though, and in reality, there isn't really a universally agreed definition. But if we were able to summarize this for you, it would be the process of taking environmental, social, and governance considerations into account when actioning investment decisions in and around the financial sector. So on the screen in front of you, you'll see we've broken it down into E, S, and G. So if we take each of those in turn, you'll see the environmental aspect that would consider accounting for the impact of climate change, how companies can adapt to mitigate, and it's often focused on greenhouse gas emissions. The social aspect, that looks at encouraging companies to consider the human element involved in the economic projects and activities, and that can include things like inequality in the workforce or inclusiveness in the workforce. If we then look at the governance point, that encourages consideration of the structure of the institutions themselves, and that can mean executive structures or even remunerations for executives. Ultimately, though, one of the key driving factors that has grown the sustainability finance sector is the impact of climate change, and that's led to the UK's commitment to reach a net zero emission target by 2050. By extension of that, sustainable finance has a relatively key part to play in reaching those targets, and that's being more widely supported by regulators and disclosure regimes that are coming into play. Next slide, please. So, as lightly touched on earlier, there are various different types of loans that fall under the ESG umbrella. ESG loans, particularly in the LMA space, are categorized into 3 categories, and you can see that in the table on the slide in front of you. So the 3 that fall under the LMA umbrella are green, social, and sustainability linked, and each category of loan mirrors what's featured in the LMA's guidance. So to begin with, what we're going to do is we're going to split this into 2 halves. We're going to look at the first 3 columns on the table, and then we're going to move on to the sustainability linked loans column at the end. So if we take green loans first, this can include any loan instrument or contingent facility that's for the exclusive use of financing, refinancing, or guaranteeing new and existing green projects like renewable energy, pollution prevention, control, and clean transportation. On the other hand, you've got blue loans, and they're basically a subset of green loans. They include any instruments or contingent facilities that are basically used for financing, refinancing, or guaranteeing marine and ocean-based projects, and they have to have a positive environmental and economic climate benefit. Separate to the blue and green loans are social loans. Now, these are used to target and fund social projects which look towards social diversification, such as giving a positive impact on target populations. So when we talk about that, what we're really thinking about here is those living below the poverty line, migrants, or even those with disabilities. And the projects that can fall under social loans are those that maybe relate to affordable housing products or sustainable food systems. For green, blue, and social loans, there are ultimately really 4 key components that need to be met. So the first relates to use of proceeds, which you'll see on the first column on the screen, row on the screen, sorry. And they must be applied to projects that the financing is being provided for. So if we take green loans, this could be a pollution prevention project. The second relates to process for project evaluation and selection. And what that means is that the borrower needs to communicate to its lender or lenders the environment sustainability objectives of the project and process to show how it fits with the specific project category. The third is the management of those proceeds. Now, ideally, you'd like to see those in an isolated or separate account that's tracked by the borrower, and it's aimed to promote the integrity of the blue, green, or social loan project. The fourth and final component is that the borrowers are required to provide reports to lenders. Ultimately, they're responsible and obligated to ensure that the information included in those reports are demonstrating what the use of proceeds is being used for, that they're kept up to date, available to the lender throughout the process, and that it discloses as much information as possible on the use of proceeds. So what ultimately is the point here is that transparency from the borrower is absolutely key. One of the key distinctions for green, blue, and social loans is that they differ from sustainability-linked loans, in that there's no margin adjustments and there's no incentive given to any of the borrowers. The key components that we just touched on a moment ago are the main parts that borrowers need to satisfy for green, blue, and social loans. And without them, they wouldn't be able to be categorized as such. Moving on to the final column in the table is sustainability-linked loans. Now, the key difference here is that the use of proceeds for sustainability-linked loans can be used for just general corporate purposes. But there is a financial incentive for the borrower to improve its sustainability profile during the tenor of the facility. And that can be through way of margin ratchet, which can impact the interest rate, and it can increase or decrease depending on the borrower's performance against specific and agreed key performance indicators. And we'll touch on that a little bit later on in the session today. What this does mean is that sustainability-linked loans are a very transitional tool. They can be used across a wide range of sectors and for a wide variety of finance products, rather than just for green, blue, or social projects. They're aimed at facilitating and supporting the environmental and socially sustainable activity and growth of the borrower themselves. So to round off all of that, the key distinction to take away is that sustainability-linked loans can be used for general corporate purposes, and they also include pricing incentives to improve the sustainability profile of the borrower, whereas green, blue, and social loans have to be used for a specific green, blue, or social project, and you do not get the benefit of any margin and pricing incentives. Next slide, please. So, as mentioned earlier, sustainability-linked financing is very much a growing trend. And on this slide, what we've included is a graph to show the growth of the sustainability-linked loan market over the last few years. Now, the graph does show sustainability-linked bonds, and that's just because there's quite simply more data available on this. But it's our view that the data is absolutely representative of the sustainability-linked loans market as a whole. You can see that the graph shows approximately a 500% increase in the use of ESG instruments between 2018 and 2021. In the leveraged loan space, 50% or around there are new money loan transactions, but that does exclude amendments and extensions, are sustainability-linked loans. And this trend is similar across all types of corporate lending, demonstrating that it's quite clear sustainability-linked provisions are very much becoming the norm, and there has been a consistent drive to continue growing in this space. Now, you'll see at the end of the graph, there is a slight drop-off between 2021 and 2023. Now, that is most likely a byproduct of the overall market instability, which has caused a general drop across the board in financing volumes, rather than what it appears to look like on its face value of it being a move away from sustainable financing. So overall, you can see this really is very much an area of growth. It's becoming increasingly important for borrowers and lenders alike, and it is definitely becoming a core part of the lending market. Next slide, please. Thank you. So, moving on to the key elements of the LMA drafting. What really must be borne in mind is that sustainability-linked loans are an unregulated product. At the moment, there is no authority or regulation that actually determines the classification of a loan as sustainability-linked. So for corporate entities, there is a risk of what's called greenwashing, along with any reputational or legal risks that are associated alongside that. Now, for lenders, that could arise due to a lack of regulation, and that's a key contribution factor as to why bodies like the LMA have published a set of guidelines and principles for sustainability-linked loans. Now, it should definitely be known and acknowledged that those principles and guidance do not have any legal force, but it is very much the market expectation that participants will act reasonably in applying them. In May this year, the LMA published a drafting of sustainability-linked loans for parties to use as a starting point. Now, the draft itself is based on the LMA's leverage credit arrangement, but it is flexible, it can be used, modified, and most certainly negotiated across a range of financing arrangements. In addition to this, the LMA's sustainability-linked loans drafting is aligned to their principles and guidance, which was recently updated in February 2023. It's absolutely essential that those guidelines are very much considered alongside the drafting of the sustainability-linked loan wording. If we take the drafting from the LMA, we think that they focus on 4 key elements. So if we just touch on those very briefly now. The first is negotiation and inclusion of key performance indicators and sustainable performance targets. The second is periodic reporting on performance against those sustainable performance targets, and also independent verification of the reporting. The third is margin adjustment, and that will very much depend on the borrower's achievement of sustainable performance targets. The fourth and final one is declassification of a sustainability-linked loan. This does happen in limited circumstances, but we're going to go back on that later on in the session. So while the drafting itself is being widely adopted in the market, from what we've seen, it's very clear that the LMA drafting should be considered as a starting point for parties looking to use it. The area itself is evolving, and parties will be required to discuss, negotiate, and customize the drafting in some detail to ensure it's modified as adequately as possible for the purpose it's going to be used. So much of the drafting has been left open to negotiation, but there is a view that as terms become more standard and they're used more frequently in the market, a general consensus will form and the scope will possibly narrow in terms of negotiation, but it is very much a space to watch. So now I'm going to be handing over to Ellis, who's going to discuss the key concepts of the LMA drafting in much more detail. So if you could turn to the next slide, please, and thank you.
Thank you, Maria. So as Maria said, a sustainability-linked loan involves assessing the borrower's performance against key performance indicators. So the first thing to consider in structuring a sustainability-linked loan is the selection of those key performance indicators. Now, the key requirements for these under LMA principles are that they need to be relevant, core, and material the overall business of the borrower and of high strategic significance to its current and future operations. So you can't just set KPIs that are focused on sort of peripheral issues and don't target the borrower's core environmental or sustainability impact. Secondly, they need to be measurable and quantifiable. The borrower is going to be assessed against its performance with respect to these KPIs, so you need to be able to measure them. And thirdly, they need to be capable of being benchmarked to facilitate determination of the level of ambition. So ideally, you're going to be benchmarking these KPIs against the performance of competitors or the performance of the wider industry to determine whether or not the borrower is being sufficiently ambitious and targeting the right areas. The selection process is bespoke to the individual borrower and often really depends on how far along the borrower is with its sustainability journey. If a borrower is sort of well advanced in its transition, then it may already have detailed reporting, detailed targets sort of already identified and part of its sustainability strategy, in which case the lender's role in this may just be sort of kicking the tires on what the borrower has already done, but broadly accepting that they already sort of know what they're doing, already have transition plans in place on which the SLL can be based. If the borrower isn't quite so far along, then the lenders are likely to need to take a more prominent and proactive role in selecting the KPIs and structuring the sustainability elements of the facility. And for doing that, one of the lenders would typically be appointed as a sustainability coordinator to collaborate with the borrower, to work with the borrower to produce appropriate KPIs that will achieve the biggest impact. And borrowers may also decide to appoint their own ESG consultant to help them with this, particularly if they don't have the necessary level of expertise internally. Now, obviously, the LMA is produced drafting, which addresses, in many areas, the principles and guidance that they produce, and it's intended to be aligned with those principles and that guidance. So for many of the areas that we'll get onto, just sort of following the LMA's drafting really gets lenders and borrowers there from the perspective of making sure that the loans qualify as SLL. But obviously the drafting can't, address the KPIs that are being selected and how ambitious they are. That sort of goes beyond the scope of the legal aspects, what we can help with, what the drafting can do for you. And it's really where lenders need to have the necessary level of expertise, and borrowers need to have that expertise or appoint that expertise to help them to make sure that the sustainability linked loan has the necessary or has the desired level of impact, and avoid greenwashing concerns. Next slide, please. So this slide is a graph from PwC based on their analysis that shows which KPIs are being seen most commonly in the market. And I'll just pick out a few of these to sort of reflect on our experience as well. Firstly, you'll see the top one and the third one down, carbon emissions and greenhouse gas emissions. I think it's pretty much universal these days that a sustainability linked loan will include a KPI relating to emissions, and these two KPIs identified here can really be aggregated to show that emissions are by far the most prevalent KPI that we're seeing today. The question often arises as to what's being tested with respect to emissions, and you hear people talk about quite regularly scope 1, scope 2, and scope 3 emissions. To sort of overly summarize, scope 1 is the borrower's own emissions from their own activities. Scope 2 would be things like the emissions for generating electricity that the borrower then uses. And scope 3 would be the emissions from the borrower's supply chain. And obviously, ideally you're going to capture all three of those when you're setting KPIs and targets for the borrower to meet. But a borrower needs to be quite far along with its analysis to have the data on, for example, the emissions that its supply chain is producing. So often, simply because the data is not available, it becomes necessary to focus on just scope 1 or scope 1 and 2 when setting borrowers' KPIs. And that sort of touches on the fact that it's really important for lenders to understand not just what KPIs the borrower is planning to meet, but how it's planning to meet them. because, for example, if you're testing emissions and looking at the borrower's own emissions, then, if they plan to reduce their emissions by sort of moving, part of their activities into their supply chain, so buying the most environmentally unfriendly parts of what they do from somebody else rather than producing those emissions themselves, then that may result in Scope 1 emissions reducing and hit their KPI, but it doesn't actually result in any benefit from a sustainability perspective. So lenders really need to understand not just what KPIs are going to be met, but how the borrower is going to meet them and whether that actually achieves the sustainability improvement that should all be aimed at. Another one I just wanted to touch on here is the ESG rating one, second one down. Now this used to be seen a lot, and you'd often just see one KPI that was, the borrower was improving its ESG rating over time. And what this is there are ESG rating agencies that the borrower can appoint that will give the borrower a rating in a similar way to a credit rating, ABC, etc., reflecting its general sort of sustainability performance. These have sort of, in my experience, fallen out of favour. So I'm a little surprised that it's quite so far up this graph, because they're sort of seen as not being particularly robust. There's very little standardization between rating agencies in these areas and the methodologies and metrics that they use. So I'm seeing those being used less often. It's not really these days seen as sufficient to just have, one KPI which relates to an ESG rating. And best practice these days is to have at least 3 KPIs. And in my experience, generally they're more focused, and rather than just being an ESG rating, there'll be a carbon emissions one and various other targeted ones that are specific to the borrower and its activity. And while the focus, I think, is still primarily on the E in the ESG, the environmental, we are seeing more social KPIs being introduced. Probably the main one is around diversity, and we see gender diversity around halfway up the graph on this page. Probably still less in the governance space, but mainly still in the E and the S of the ESG. But we are seeing, at least 3 KPIs now on transactions, and sometimes more than that. Next slide, please. So we've set our KPIs, we know what areas we're focusing on. The next stage in this process of structuring an SLL is to calibrate what the targets are that we're focusing on. And the acronym here is SPTs, which is Sustainability Performance Targets, which is basically just, for each KPI that we've set, what is the target that the borrower is aiming to reach for that KPI. And the requirement is that these KPIs need to be relevant, they need to be ambitious, and they need to be beyond a sort of business as usual trajectory, and certainly beyond regulatory requirements. So they need to be going further than the borrower would otherwise be going or would be required to go, and really to demonstrate that level of ambition by the borrower to improve in the selected areas. Where possible, as with the KPIs, the SPTs should be capable of external reference or benchmarking, maybe against the company's own historic performance, or against peers, or against science-based targets that are aligned with net zero. And typically, these targets are set on an annual basis. That's certainly the recommendation, although it may not be may not be possible in all cases. For example, on a shorter-term facility. But there needs to be a strong rationale as to why the targets shouldn't be set annually. So typically what you'll see is for each KPI, there'll be an annual SPT, and those SPTs will be reflecting a need to improve year on year during each year of the tenor of the facility. And how they're phrased and how they're documented will depend on the nature of the KPI. So for emissions, it could be a total number of tons of CO2 per year. We've been seeing that reducing over time, or it could be a percentage reduction on the baseline level, and it could be phrased in different ways depending on the KPI. And to enable the lenders to really understand the level of ambitiousness and help the borrower with setting these SPTs, the borrower will need to provide a significant amount of information to the lenders before signing, while the sort of being structured, so that they can demonstrate the relevant ambition of the KPIs and the SPTs, their alignment with science and the borrower's sustainability goals, as well as in what situations further down the line, potentially they might need to be adjusted, and we'll get onto that side of it, I think on the slide. But these SPTs and their calibration is bespoke to the business. It's, reflecting where the starting point is and where they need to get to, and they need to be consistent with borrower's own sustainability strategy. And as with KPIs, borrowers will often appoint their own advisors to assist them with this, where they don't have the necessary expertise internally. Next slide, please. So we've talked about setting the SPTs at the outset of the facility, but there are a couple of scenarios worth talking about where it could become necessary to change them later on. And one of those is what's referred to as a rendezvous clause. We didn't always used to see this in facilities before the LMA introduced the language, but I think it's a really important addition to make sure that the SPTs remain relevant and ambitious throughout the tenure of the facility. The LMA concept on this is referred to as sustainability amendment events. And under the LMA, essentially what happens is if a sustainability amendment event occurs, then that brings everyone to the table to renegotiate the SPT KPIs to see if they need to be adjusted. And the LMA refers to a sustainability amendment event occurring when a change occurs to a group business or the qualification is included in a verification report that could reasonably be expected to have a material impact on a KPI or an SPT. Now that's a bit of a mouthful, but what it's really referring to is, for example, significant M&A activity by a borrower or significant disposal, which means that the group has significantly changed from an ESG perspective, and therefore, for example, an emissions target that was set previously may be, incapable of being achieved because they've acquired a particularly polluting business, or it may be too not ambitious enough because they've disposed of a polluting part of their business, and it's therefore far too easy to achieve those targets without actually improving. So the idea is that if these things happen, then we shouldn't just continue to refer to the loan sustainability link, even though it's not really ambitious anymore. We should all get back to the table, renegotiate the KPIs and the SPTs, and make sure that it's fit for purpose going forward. So the LMA drafting is really focused on those kind of M&A activity, disposals, those type of events. But there could be other things that lenders might want to include here. For example, if the borrower announces more ambitious targets publicly than what's in the facility agreement, or if it agrees more ambitious targets with other lenders, then lenders may feel that their facility needs to be brought in line with that. You wouldn't typically see like a most favored nation concept where that alignment is automatic. Usually it's it triggers a discussion, and everyone's required to get around the table and have a good faith discussion for a certain period to try to agree an amendment. And ultimately the risk if for the borrower, if that doesn't get agreed, is declassification of the loan and sustainability thing, but we'll get onto that later. So all of this ensures that the KPIs and the SPTs remain relevant and ambitious throughout the tenor of the facility. And the borrower will want to make sure, first of all, that this can't be triggered too readily, but also it gives the borrower to make sure that it can amend the facility should that be needed. And the borrower will be keen to make sure that the level of lender consent here isn't too high, and we're usually pushing for a majority lender consent for agreeing any amendments to the SPTs and the KPIs. But there are various considerations go into that, including the sort of size of the syndicate and relative amount proportions that each lender is contributing there. And I thought it'd just be worth me giving an example from my practice before the LMA published its language of why I think this is so important. I was acting for a borrower a couple of years ago on a facility, and they had really structured their KPIs and SPTs without any real external input. And when it came to the first sort of testing date, they got an external reviewer on board to advise them. And the external reviewer gave advice that actually the methodology they were using to calculate their emissions was all wrong, and they could use a different, better methodology, which would be more accurate. Now, the thing was that when they applied that methodology, it resulted in a significantly reduced amount of emissions. And there was nothing in the facility agreement to prevent them from changing the methodology they were using. So actually, they could have just, changed the methodology, reported a significantly lower emissions, and complied with their KPIs extremely easily without improving their business at all. Fortunately, the borrower did the right thing and approached the lender and said, look, the aim of entering into this facility is because we want to improve, and therefore we've changed the methodology. We want to amend the targets to make them tighter and make them ambitious. But there was nothing contractually that forced them to do that in the facility. So I think it is really important that that provisions are now being introduced that don't just rely on good practice of borrowers and actually enable the lenders to bring borrowers back to the table to renegotiate these things if that becomes necessary. The other concept mentioned on the slide is sleeping SLLs. This is a scenario which is really discouraged, but is where a facility agreement entered into that has all of the mechanics of an FLL, but with no KPIs or FTTs agreed at the outset, with the intention being that they're going to be agreed further down the line. The concern here is really that if they're just kicked down the road until later, then they won't get the same level of scrutiny as they would if they were being negotiated up front. And therefore, will it be as robust an FLL if that's what's happening? But it is acknowledged that there could be some situations in which it's appropriate, like where there is a lot of time pressure to get the deal done, and the borrower already has an advanced sustainability strategy. So it's not that people are just trying to gloss over the aspects of it. It's just the good reason that needs to happen a little bit later. So it's sort of discouraged, but accepted that it could be appropriate in some cases, as long as everything is done and KPIs are agreed, SPTs are agreed, and all the other core components are met within 12 months. So it can be turned on as a sustainability linked loan within 12 months of signing. And typically, when it is turned on, it's going to need all lender consent for the KPIs and the SPTs. Although again, that may not be appropriate where there's a particularly large syndicate, for example. Just worth drawing a distinction here between sleeping SLLs that I've just described and something you do also see where maybe you don't set the SPTs for some of the years that are quite far out at the outset. So this would sometimes happen if you've got a facility that's sort of 3 years with an extension option for another 1 year and another one after that. So 3 + 1 + 1. You may not set the SPT to the extension years at the outset, simply because everyone sort of agrees that you're going to have better data in a couple of years' time to set those SPTs for the years that are quite a long way ahead, and those SPTs can be set as part of the amendment process or part of the extension process when it comes to extend the tenor. So that's absolutely fine. That's not a sleeping SLL. There's no sort of controversy around that, and that happens all the time. So just a distinction between sleeping SLLs and ones where you don't necessarily set the SPTs for years that are quite far out in time. Next slide, please. So we've talked about the KPIs and the SPTs. So what the borrower is going to be reviewed against and what they're going to be judged against. The next thing to consider is what happens if they meet their SPTs or don't meet their SPTs for any given year. And there's obviously no default for failing to meet the SPTs for any KPI. All of this that we've talked about flows through into a margin ratchet that is intended to incentivize achieving the SPTs with a reduction or potentially an increase in the margin. Now, the margin ratchet applies annually, aligned with the annual targets that we've discussed, and it doesn't apply cumulatively. So you have a readjustment every year, but you don't get, if you've had a margin reduction the previous year because you hit all your KPIs and you hit all of the KPIs for a second year, you don't get a further reduction. It's just reduced to the level that it would be for meeting all the KPIs. And while not mandatory, the way the margin ratchet would typically work is that the margin can go up as well as down. So what you'll often have, for example, if you've got 3 KPIs, is that if you hit the SPT for one of them, then the margin stays the same, sort of the base level margin. If you don't hit any of them, then you get a margin increase. If you hit 2 of them, you get a decrease, and if you hit all 3 of them, you get a bigger decrease. So the sort of baseline margin is set somewhere in the middle of the failing to achieve any of the KPIs and achieving all the KPIs. And typically, and certainly the way the LMA drafts it, all of the KPIs are weighted equally, so it's all just on the number that you achieve or don't achieve. But you could weight some more heavily than others, so that some are considered more important, and achieving and not achieving them has a bigger impact. But that's not in the LMA drafting. Now, I guess the obvious question that sort of comes up here is, how big is the pricing impact? What is the incentive? And one of the main criticisms of this product is that the pricing incentive tends to be fairly insignificant. So in the investment grade world, typically, the maximum margin reduction you're likely to see is somewhere between 2.5 and 5 basis points. In leverage finance, a little bit more, maybe 7.5 to 15 basis points. But pretty low in the context of what the overall margin is likely to be for the facility. And that leads to concern as to whether it is actually achieving the purpose that it's designed to, and the purpose it's intended to be to incentivize borrowers to financially to improve their sustainability performance. Whereas given the low levels of financial incentivization, really it relies on the borrower wanting to do the right thing anyway, rather than doing it because of financial incentives. So there is some criticism there. Lenders obviously typically disinclined to give a more material margin reduction, and there's a concern obviously with borrowers that they're unlikely to adopt the product at all if there's a risk they can have a more material pricing increase, which is why the pricing changes are fairly insignificant. Some other points to consider on the ratchet. If you have obviously another ratchet in the facility, then you'll need to give consideration to how this gets layered over the top of it. So, for example, you might have another ratchet that's linked to compliance with financial covenants. And so this margin ratchet for the sustainability aspects would be layered over the top of that. The LMA doesn't address that at all in its drafting, but it's all achievable in practice. Secondly, if there is a sustainability breach, so for example, if the borrower is late or fails to deliver on their reporting obligations, which we'll get on to shortly, then there's no default. There's no default for breach of sustainability provisions, but typically all of the KPIs will be considered to have been breached, and the margin will go up to the highest level in the ratchet. The LMA drafting is a little ambiguous in this area as to whether it would go up to the highest level for the whole of the next year, or whether it's just until the borrower gets back in compliance with its obligation. Obviously, the borrower will want to make sure that it's clear that once they're back in compliance, then the margin ratchet applies again. And the other concept mentioned on this slide is what is referred to as ESG controversy clauses, which is, you see it in particularly risky industries. So, for example, in oil extraction, for example, if you've got a borrower that it has KPIs linked to emissions, and it's on course to meet its KPIs and get the maximum reduction, but in the background or alongside that, they have a massive oil spill and sort of untold ecological damage, then do lenders really want to allow a situation where the borrower is being treated as if it's ticking all the boxes from a sustainability perspective, but alongside that, there's a big controversy or ecological stuff unfolding. So you do sometimes see in those more risky areas what's called the ESG controversy clause, which would override the margin ratchet and take margin up to the higher level if there is a controversy that isn't captured by the KPIs. Pretty rare, and it's not addressed by the LMA drafting, and if that is something that you want to include in the facility, there's quite a lot to negotiate there in terms of how you define an ESG controversy, how long it applies for, etc. But something to be aware of and a risk to be considered from a greenwashing perspective where you're dealing with risk and borrowers. Next slide, please. So we've talked about really the core of the commercial aspects of the sustainability linked loan. You've got, you're being judged against the KPIs and the SPTs, and if you achieve them, you get a margin reduction. If you don't achieve them, you get the margin increase. And that is really the core fundamental commercial aspects. But obviously, there's a lot of important drafting alongside that, and one part of that is the reporting obligation from the borrower, which support the sustainability linked features of the facility and make sure that the lenders have all of the visibility they need. The LMA doesn't include any additional CPs, although you may want to include additional CPs in relation to things like, reports from third parties on borrowers' track records, or reports from the borrower itself even, or external reviews of the KPIs and methodologies and that sort of thing. You sometimes do that. Sometimes it's a CP, but sometimes just things that be dealt with before signing that don't need to be included in the facility agreement. The primary mechanism for reporting in the LMA is the sustainability compliance certificate, which gets delivered annually in line with the annual SPTs. And under the LMA provisions, that compliance certificate would include confirmation that the borrower's performance against the SPT for each KPI, calculations supporting that, an assessment from the borrower of how that affects its margin under the ratchet, and it would also attach the borrower's sustainability report, as well as third-party verification report, which we'll get onto in a second. The timing for that's left open. Obviously, it's annual, but exactly when it happens is left open by the LMA drafting. But it's really important for borrowers to make sure when they're structuring these that they can deliver on what they're agreeing to. I have seen it before where it doesn't really get thought about when the facility being structured, but when borrowers come to make their first report 6 months later, they find that the timings for approving their sustainability report don't fit in with their timings for certain other things that they're approving internally and can't be met, and then everyone sort of needs to get back to the table and agree amendments and that sort of thing, which isn't what anyone wants. So it's really important for the mechanics of this to be thought about up front. And then there's other reporting requirements alongside that, like rights for the lenders to request additional sustainability information. Next slide, please. Now, we touched on before that the compliance certificate needs to be accompanied by a verification report, and it's really fundamental under the LMA principle that third-party verification is required, and that's achieved through one or more third-party independent reviewers being appointed to review the borrower's reporting. Commonly, that could be an auditor, it could be an environmental consultant, an ESG rating agency. It really depends on what the KPI is, and often you'll have different verifiers for different KPIs. The aim should be to meet the verification requirements with a minimum of extra work and expense. It shouldn't be to create a whole additional sort of industry in itself. And often, if a borrower is actually already quite far along this transition, it may already be producing these types of third-party reports on an ongoing basis, so it may not actually need that anything additional that's being produced over and above what the borrower is already producing. And as with the borrower's own reporting, we need to make sure that the borrower can deliver on what they're agreeing to deliver. So the language relating to what verification actually means is key. Because if we say that the borrower, the third party needs to verify it, but actually in order to only give a limited or reasonable assurance, then questions as to whether that actually is the requirement. So the borrower should really be engaging with the third party reviewer at the outset, rather than just leaving it to the first time they need to get something verified and then find that actually they can't get what the agreement requires. Typically, a borrower will be able to change its reviewer without lender consent, as long as the reviewer complies with or meets certain requirements. So being independent, for example, being regularly engaged in this type of activity, possibly being internationally recognized. Typically, as long as the proposed replacement reviewer meets those requirements, it shouldn't usually require lender consent, although some lenders do require a consent right. And market practice isn't for lenders to have reliance on these reports. They receive them for information only, but they're not addressed to the lenders. They don't have reliance on them typically. Next slide, please. So those are the main features. The other area worth focusing on from the other key sort of commercial area is declassification. We touched on that earlier in the context of sustainability amendment events. But this is the process by which lenders could declassify a loan as a sustainability-linked loan. And the inclusion of these clauses is really being driven by greenwashing concerns from the lenders and the lenders' own reporting and targets for deploying their capital towards sustainable finance. And these clauses allow the lenders to make a decision to declassify the loan as sustainability linked upon the occurrence of certain triggers. So, for example, if a sustainability amendment event occurs, which we talked about earlier, but the parties can't agree amendments within the agreed period, then the lenders will be able to take a decision to declassify the facility. But the other declassification events could be included on KPI, on a case-by-case basis. So persistent misreporting, consecutive non-achievement KPIs, that kind of thing could be introduced as an additional declassification event, although it's not in the LMA. Obviously, declassification could result in significant reputational concerns for borrowers, so they will want to make sure that these events are minimized, that they're not easily triggered, that they're within the borrower's control, and that they're objective and not subjective matters for the lenders to decide upon. And as a result, these areas are often some of the most heavily negotiated provisions. Next slide, please. Just finishing off on declassification, borrowers will typically want there to be some sort of grace period for them to be able to remedy matters before the lenders can take a decision to declassify. There's often some discussion as to whether it should be a majority lender or an all lender consent to declassify the facility. Borrowers will often, they'll obviously in more cases want to be all lender, and that may or may not be appropriate depending on the size of the syndicate. And the impact of declassification, the two main impacts: first of all, the margin ratchet falls away. Typically, that means that the margin goes to its baseline, which may be the highest level, or it may be somewhere in the middle, as we discussed earlier. And the other key requirement is that after a loan is declassified, no member of the group can refer to it anymore as being sustainability linked. And breach of that obligation, unlike the other sustainability provisions, would cause an event of default. Occasionally, you see lenders ask for things like historic publicity being removed, or the borrower making an announcement that it's no longer sustainable. But you don't really see those that much in practice these days, and borrowers to push back on that. I mean, with removal of historic publicity, often concerned as to whether that's even practical or possible in practice. And typically, once a loan is declassified, there's no mechanic for reclassifying it. So if it does get declassified, then that's it. It's unlikely to ever get reclassified as a sustainability linked loan. And just finishing off before I hand back to Maria, the other topic worth mentioning briefly is the role of the sustainability coordinator and their protection. We talked earlier that they're involved in the structuring of the KPIs and the equity with the borrower. They're not a party to the facility agreement under the LMA drafting, but they do get the benefit of the protective provisions in the facility agreement under the Third Party Rights Act. And actually, those protective provisions have been significantly expanded to make sure that they cover they cover all sustainability aspects. So the borrower will get, the sustainability coordinator will receive indemnities, and all of the administrative parties will have protection in relation to sustainability matters, which was a bit of a hot topic before the LMA introduced their drafting. So that's it from me, and I'll hand back over to Maria to conclude and to go through a couple of other matters.
Thanks, Ellis. Can I have the next slide, please? Oh, and next slide again, please. Thank you. So we're going to round off this session by just briefly touching on what the future looks like for sustainable financing. And hopefully we're going to draw out some of the key concerns that perhaps are being contemplated by parties that are looking to use sustainable financing arrangements. So the most prominent issue that users of sustainable financing seem to be focused on is very much greenwashing. Greenwashing is essentially achieved if a party gains an unfair competitive advantage by marketing a financial product as environmentally friendly, but really it doesn't actually meet the basic environmental standards that it should do to enable it to actually be classified as sustainable. So if we take to look from a lender's perspective, as sustainable financing is unregulated, there is no guarantee that the sustainable financing users will abuse the arrangement by perhaps trying to negotiate unambitious sustainable performance targets or weak incentives to meet the agreed key performance indicators. So earlier this year, the FCA actually wrote an open letter to all lenders highlighting and documenting their observations on the key issues of sustainable finance to help build a more transparent market. Now, some of the key points that the letter drew emphasis on related to the lack of ambitiousness of key performance indicators and sustainable performance targets, along with weaker incentives, potential conflicts of interest, and each of those could lead to accusations of greenwashing. And this could potentially tarnish the integrity of the sustainable finance market, so it obviously is something that people are considering. To counterbalance that, though, and the FCA's overall scrutiny and the risk of greenwashing, what we've actually seen is that there's a growth of legislative and regulatory information that they're rolling out different initiatives that are basically intended to prevent or mitigate the risk of such situations happening. So really what's clear is that with the rise of regulations and also rise of disclosure obligations for sustainable financing, we're hoping and seeing that potentially it's going to become more regulated. Voluntary disclosure arrangements will probably end up becoming mandatory. And especially as we get nearer to the 2050 mark, we might see that regulators are going to want to direct more capital flow to see if they can push towards meeting that net zero target. Another point of concern might lay amongst those operating in the trade finance sphere. Now, in particular, sustainability-linked principles and requirements can apply to short-term facilities. And we've touched previously on setting sustainable performance targets, which do typically work for facilities that have a multi-year tenor. However, it is very much the position that the market is still considering how those SBT concepts and KPIs can apply into shorter-term facilities. So it is very much a space to watch, and we'll certainly be looking at that going forward. Lastly, and in light of the above, there's no doubt that as more sustainable financings are entered into, we may see an increase in commercial disputes relating to loss and damage costs associated for non-compliance to disclosure requirements, greenwashing, or even perhaps a breach of fiduciary duties of directors. The evolution of sustainability-linked loans is an area worth watching, and we are very much looking forward to seeing how the market adapts to see how it further integrates into financing going forward in the future. Next slide, please. So to summarize everything that we've covered today in a very short few bullet points, what we really hope that you'll take away from today's session is that sustainable financing is very much continuing to be at the forefront of boardroom discussions. Greenwashing, legal and reputational risks are a concern for lenders, but that is counterbalanced by the LMA publishing guidance and principles. And hopefully that's going to assist parties going forward to navigate sustainable financing arrangements more successfully. Parties are also going to need to consider what KPIs and SPTs are most suitable for them, and the financing that they're looking to obtain to try and reduce the risk of declassification And lastly, we're going to see that there's going to be more regulatory focuses moving forward. And that's especially in light of the FCA's recently published letter addressing greenwashing and the wider sustainability-linked loan market. Companies are going to want to ensure that no reputational damage is incurred when using sustainability-linked loans, as there is more risk due to the fact that this type of financing is at the moment still slightly less regulated. So that concludes today's main discussion. If we can move on to the next slide, hopefully we'll have some time to look at some questions. Thank you.
Yeah, thank you to those that have submitted some questions. We're coming up to a full hour, so I don't think we'll have time to address all of them, but just picking out a couple. There's a question around given increased focus on public on sustainability loans and there being a risk of greenwashing, even where the provisions are done diligently, do we think that there's a risk that banks and companies, including that they aren't worth the hassle? To be honest, I think the direction of travel is not that, it is very much that sustainability is going to become an even bigger feature of what we're doing. I see the potential for more regulation in this space and greenwashing being addressed or thought to be addressed that way. But I don't think that these type of loans are something that's going to go away because of that. I just don't think the direction of travel is in that direction. I think there's going to be much more focus on the sustainability of bank portfolios and banks needing to, ensure that things are done as robustly as possible. I was at a conference relatively recently with one of the major banks who was asked by a very major corporate and a very major client of theirs if they were going to continue to be able to do business with them in the future. And the bank had to say that we just don't know because the industry they're in is one that can't easily be made green. So I agree that greenwashing is a concern, but I don't think that it's likely to result in banks pulling away from the FLL market. I think that really there is little choice but to continue to green portfolios really. I'll just try and answer one more question here, which is if lenders are not permitted to rely on verification reports, and what's the point of having them? Does it mean lenders have to perform their own audits on borrower KPI performance? I think lenders can't rely on them in the sense that lenders couldn't sue the verifier, if they got it wrong, or they don't have sort of formal legal reliance on that basis. But the protection for the lenders is that they have to agree who the verifier is going to be up front, or if the verifier is changed, it needs to meet certain requirements in terms of it being sort of a verifier that's of repute. So really, I think lenders rely on that rather than the fact that they're going to be able to sue the third party if they get it wrong. I mean, even if they have reliance, it's questionable what the damages that the lender would suffer as a result of that report being wrong that would enable them to actually make a recovery from that third party. So I think really lenders are comfortable that they don't necessarily need full reliance on those reports. And it's probably something for lenders internally that we get involved in, but certainly I don't see lenders talking about doing their own audits of those reports. Although, as I said, there are obligations on the borrower to provide additional sustainability information if the lender's request. So they could be required to provide information for the lender to look into it more themselves. But thank you to those that asked questions. I'm sorry we don't have time to get to all of them. But we are at our full hour and we don't keep you any longer. So thank you everybody for joining. We would be absolutely delighted to answer anything else if you want to send it to us bilaterally. And if we could just go to the slides with contact details on for Maria and me, or otherwise, feel free to reach out to any of your other Sullivan contacts. And if there's anything that we can assist you with in this area, then please do get in touch. We would be delighted to help you.